One fund on point for today, the expert to talk about it. Welcome to the ETF of the Week. Yes, this is the ETF of the Week, where we examine trending, new, newsworthy, unique, and intriguing exchange-traded funds with the help of Todd Rosenbluth, the head of research at VettaFi. And at VettaFi.com, you can dig in to explore the ETFs that you find intriguing and find all the tools you need to make yourself a better fund investor. Todd Rosenbluth, it's great to chat with you again.
It's great to be back, Chuck.
Your ETF of the week is
the SPDR S&P Dividend ETF, SDY.
SDY, the SPDR S&P Dividend ETF. Now, this is a fund that has been ETF of the week before, though not with you, not since you started doing the ETF of the week with me, but it's back now. It's been a pretty good performer this year relative to the rest of the market. Is that why it's here, or is it because as stocks go, this is kind of a safe haven?
So this is a safe haven, and this is not a new fund. This fund, I think, has a 20-year history, and 20 years is interesting because it requires, or the fund requires, a company to have a 20-year history of raising dividends in order for it to be included in the portfolio. And there are some holdings that are 40, 50 years old that are in SDY. But given the market volatility, given that folks are trying to figure out what to do to get income, given the weirdness, I can't come up with a better word, than weirdness that's going on in the bond market in relation to tariffs, we think SDY is a high-quality, safe haven, dividend-paying ETF from State Street.
You know, here we are doing the ETF of the week, but we seldom talk about what happens in any given week. And yet this fund is interesting to me because right about now, we kind of do want to look at what happened to funds in the first week or so of tariffs. And this fund was trading at about 136 a share. It moved down. It lost a little bit more than 10%, and it's gained a lot of that back. Is this a fund where you wouldn't necessarily expect it to get all of the upside potential, but you'd think that the dividends give you the cushion so that you won't get all of the downside as well?
Yeah, so the dividends, obviously that's part of the name. The dividend component of this, not only the income, but that relative safety of the dividends has helped this ETF hold up relatively well during times of market volatility, but still participate in the gains. And there's a lot of uncertainty. Companies are trying to figure out how to navigate through this new tariff on, tariff off, tariff on again environment. A company that has raised a dividend for 20 plus years, they're committed to this. You as an investor, you as an advisor should have comfort that you're going to get the benefit of stability with this. Not only are they going to pay, likely to pay the dividend, not only in 2025, but beyond, but likely to raise that dividend. And because we've got more than 100 stocks here, even if one of the companies that's inside the portfolio cuts its dividend, one or two, you got the benefits of diversification instead of trying to buy an individual dividend paying stock alone.
At the same time, I mean, you mentioned the possibility of dividend cuts. That would be really odd because, again, these are dividend champions. I mean, they have to have this long history of paying a dividend, and I believe it has to be rising or at least not shrinking. So,
no, rising. It has to rise. So 20 plus years of increasing the dividend. And so for a company to have increased its dividend, they have confidence, they being management and the board of directors has confidence in the fundamental strength of the company, that they don't need that cash to grow. They can actually reward shareholders and pay back. So 20 years of dividend increases plus, and some of those are 40, 50 years dividend increases, is a great sign. And then one last thing, I know I interrupted you, is that this is not just a large cap portfolio. And people tend to think of large cap companies as the ones that are paying dividends. There is roughly 30% of the portfolio that's in small and mid cap companies. They're paying dividends too. They give you a bit more of a growth perspective than what you'd find in your traditional large cap dividend ETF.
If somebody's looking at this fund and they kind of want to see how it performs under stress, would the likely period that you want to look at be COVID? Because functionally, that was a time when you saw dividend paying stocks get really challenged. And we did see a couple of dividend champs that wound up suspending or cutting dividends and getting kicked out of portfolios like this. But again, you're not facing, oh my goodness, a dividend cut. If they cut it, they're out. But you are going, what goes through? So is a period like COVID, for somebody who's looking at this going, I wonder how it's going to do, can you get a good relative sense? There was that much uncertainty then. If we're going to go through that now, it's a good way to look at it.
That is a good example. That was one of those time periods where the market had a knee-jerk, an understandable knee-jerk reaction. Companies had to realign their businesses to take effect. This is a bit different, but yet it's a good example. There's a 20-year or so history that folks can take a look at how SDY, which is tied to an S&P index, how it held up during times of market volatility, and then how it participated in the gains. And so this fund has a strong track record relative to other dividend strategies. Part of that is its long-term record of dividend growth. Part of it is its small and mid-cap exposure that makes it different. It's a well-constructed ETF from State Street, and it's no surprise that it's one of the more popular dividend ETFs.
It is interesting to me, the timing of this one. And when I look at funds, I tend to look at longer term performance, but then I look at how they got there. And if you're looking at the last 10 years on this fund, there's a couple years where it's top 10%, et cetera. But 23 and 24, two banger years on the stock market, this fund has been at the bottom of its peer group. 2023, it was in the bottom 5% of its peer group, no matter who's measuring it. And then 24, it was like the bottom quartile of its peer group. Now, thus far this year, top 10% of its peer group. So is this a long-term, let's be committed to it because we love dividend strategies and the rest? Or is this is playing defense at a time when you want to play defense?
So I'm going to go with both. There's a use case for both for this. If you are relatively long in the market and had been bullish, and this volatility that we've seen in the past month, not only this year, but the past month in particular, has you more concerned. This is a slightly more defensive way of getting equity exposure. I say slightly. The dividend is going to provide that some of that downside protections and that income generation that's going to be appealing to you, but you're still going to get a good majority of those gains. You're not, this isn't a buffer ETF. This isn't a low volatility ETF. This is a dividend ETF, and there are certain characteristics. So this can be added to an existing portfolio to reduce some of the equity risk that you'd have in an S&P 500 or even a multi-cap, market cap weighted strategy. But this also can be a core position for many folks that just want that prioritize income, prioritize stability. They're okay not getting all of the gains. They want a little bit more income generation than what you'd find within the broader marketplace. This is a good core position for many people to have in the portfolio. There's going to be some years that are better, some that are going to be worse. A long-term track record, I think, speaks for itself. I believe this is a 4-star Morningstar rated fund and has a strong long-term track record.
It is, and also Lipper gives it its highest ratings for preservation of capital, low expenses, and tax efficiency. So it is a well thought of fund. It's the SPDR S&P Dividend ETF, the ETF of the week from Todd Rosenbluth at VettaFi. Todd, talk to you again next week.
See you next week, Chuck.
The ETF of the week is a joint production of VettaFi and Moneylife with Chuck Jaffe. And yeah, I'm Chuck Jaffe, and I'd love it if you check out my hour-long weekday show by going to MoneyLifeShow.com, by looking for it wherever you find your favorite podcasts. Now, if you're looking for information on your favorite ETFs or what might be your next favorite ETF, go to VettaFi.com, where they have a full suite of tools to help you out. They're on X at Vetta_Fi, and Todd Rosenbluth, my guest, their head of research, he's on X as well at Todd Rosenbluth. The ETF of the week is here for you every Thursday. Make sure you subscribe on your favorite podcast app so you don't miss an episode. And we'll be back with another great ETF for you to consider next week. Until then, happy investing, everybody.